Very good morning, everyone, and thank you for joining September's edition of Blackfinch's 10-Minute Market Forecast. My name is Josh, and I'm the product specialist for our listed investment solutions. And for those of you that are new to the webinar today, we look to explore what's happened over the previous month and consider how current economic conditions could impact markets going forward. And this should hopefully give you some nuggets to take away for your client meetings this week. And as I'm sure you're well aware, it really has been an action-packed month in August. We've seen some strong volatility recently, both in terms of upside and downside market movements and key macroeconomic events mixed in with this also. So should you have any burning questions that I may not have touched on over these 10 minutes or that your clients have asked you directly, then please use the strategic team at blackfinch.com inbox and we'll ensure to get back to you. Equally, you can submit your questions prior to the webinar for us to discuss. Now then, so let's start off with the beginning of August, and it really was quite a short and strange journey. That first week of August marked the worst global market correction since the first month of the pandemic in 2020. And then less than 2 weeks later, much of the damage was already fixed, and it just left investors scratching their heads wondering what on earth had happened. And just for some context in terms of actual company share price movements for NVIDIA, which is the most exciting stock on the globe at the moment, the correction brought its market cap down by $900 billion, only to regain nearly 600 of that over the next 5 trading days. And it's almost created a rather dramatic V shape if you're looking at a line chart. And this is the case for many indices that we look at today. And we've touched a lot of this on the previous webinar, but for the most part, the volatility was driven by weaker than expected US economic data, concerns over of wider global growth, with the hard landing scenario rearing its head once again. And then on top of this, the yen's exchange rate at the time was hit by the infamous carry trade, which is the practice of borrowing at rock bottom rates and then parking the money elsewhere, in which this year for the most part has been the yen to the Mexican peso, among other currencies. And the correction caused by weaker economic data from the US market directly coincided with this carry trade collapse, in which the yen rallied and sparked significant uncertainty over the forward outlook. Now, in our view, this market event was driven by informational inefficiencies and a lot of fear, rather than material changes to the long-term economic picture. We had that short-term spike in economic data that flickered recession, but once the dust had settled, markets could quickly understand what had happened, recover the losses over the course of the 2 weeks, as that hard landing scenario somewhat dissipated. Now, the important factor to consider both now and going forward is that global markets are pivoting away from viewing inflation risk as an issue, and instead we've moved on to recession risk. And this risk rapidly changes investors' views on their investments. Now, our textbooks tell us that if the risk to returns is caused by a potential recession, then holding bonds is a sensible decision, as they're perceived as less risky than stocks. They can offer lower volatility to provide some shelter from the storm. And this is exactly what we saw in August. At Blackfinch, we regularly track capital flows from exchange-traded funds and relevant indices, and we saw the sharpest switch from stocks to bonds since 2020. And of course, fixed income returns followed suit. They performed well over the period, including gilts and investment-grade corporate bonds. But this perceived switch in focus from inflation to recession could be further supportive for bonds over the near term, and is an important factor in providing sustained investment returns in a well-diversified portfolio. Now, I mentioned NVIDIA at the start of the webinar, and I think it's worth giving a quick update on what's currently going on at the moment, and since the Magnificent Seven has such a large influence on US equity returns. And when NVIDIA's results were released at the end of August, people anticipated nothing less than perfection after a string of extraordinary earnings beats. And it was perfect for the most part, but NVIDIA's 122% year-on-year revenue growth just wasn't enough to please the masses, who were expecting 150% earnings growth, which, you know, in itself is quite unheard of for a company of that size. But equally, investors didn't really get enough reassurance on how the company's next-gen Blackwell chip is going to roll out, and then after the call, its shares were down about 8% after hours. And it certainly feels like the company's growth has just been so enormous that it needs to not just beat expectations to rise further, but blow them out of the water. And looking forward, we still see global data centers remaining a key theme over the coming years and to support that digitalization trend. And this is something we seek to capture in our multi-asset portfolios and real asset funds. But we do see this kind of volatility continuing on when we see potential earnings misses, as there is just such precedent being placed on what AI can do at the moment. And if we move on to monetary policy and consider the actions of developed central banks, it's an important month for investors. So starting in the UK, inflation remains range-bound at 2%, with July showing a slight tick up to 2.2% over the 12 months. And that uptick came from gas and electricity prices because they fell less than they did a year ago. And then the largest contribution came from restaurants and hotels where prices fell. And positively, economists polled by Reuters had expected an increase to 2.3%. So that's a nice little miss there for the UK economy. And I think it's important to mention that even though overall price pressures are above 2%, the general direction of travel is still trending downwards, which is an encouraging sign for the bank's rate setters. And then on top of that, the ONS stated that wage growth had dropped to a 2-year low of 4.5%, and that adds to the cooling economy narrative and lessening fears of a sharp recession. Now, for the US, the major macro event of the month was Federal Reserve Chair Jerome Powell's speech at the Jackson Hole Symposium, and stocks jumped at the opening of the trading on that day following the release of the text of his speech. And the text is really important. So he outright acknowledged that the time has come for policy to adjust, implying that policymakers would cut rates at their upcoming meeting on the 18th of September. But not just that, Powell left some room for the possibility that rates could be cut by 50 basis points instead of the usual 25, but markets feel the latter is more likely at this point. And then in terms of other key events to look out for the US, the employment report is going to be crucial for September, and this is in fact coming up this Friday. So it includes the unemployment rate being published, which is expected to remain nice and level at 4.3%. But more importantly, we have the non-farm payrolls report coming out too. So as a quick reminder, this is a monthly statistic showing how many jobs are added or gained in the US relative to the previous month. And we're expecting this to come in at around 120,000 additional jobs. Now, should this really miss estimates, we will expect some volatility, as there's still a lot of sensitivity around this economic data point at the moment and the wider trajectory of the US economy. This figure will likely feed into Jerome Powell's decision on interest rates too. Now, before the Fed on the 18th of September, we have the European Central Bank's decision on the 12th, Thursday the 12th of September. Now, the ECB has actually been out of the spotlight for some time now, and they've already cut their interest rate by 25 basis points, and they seem likely to go again this month. Their headline inflation figures dropped to target, notably. The German economy specifically is showing signs of cooling on that inflation front, and we could likely see some trading activity on this date, and there's potential for upside market movements here, providing we get that 25 bip cut. And I've touched on the Bank of England already, but that meeting is on Thursday, the 19th of September, the day after the Fed. And as I've mentioned, the jury's still out on whether we'll see 2 consecutive interest rate cuts. I think it's likely that Andrew Bailey will want to see how the dust settles on that first cut before firing the trigger again. But again, we've already seen how strongly small to medium-sized companies have performed recently, and that sensitivity could still be on show again at the next meeting. If we do get the cut, we could see some share price rally there. And finally, of course, we've seen politics dominate headlines recently. Now, as we've seen over recent years, public addresses can cause some stir in markets due to the uncertainty that they can bring. But with the long-term lens, these don't really move the needle enough to have significant sway on policymakers especially. But we have the UK budget coming up in October, with speculation already circulating on what Sir Keir Starmer may look to change and then how that's going to impact consumers. But for some context for the UK market, his recent speech has already ruled out many factors, such as raising income tax, national insurance and VAT, which would account for approximately 75% of the government's income. So we believe at this stage, the average consumer may be somewhat sheltered from the upcoming changes, but we're going to be monitoring this very closely over the coming weeks to see how this develops and what this may mean for UK investors. But that's everything from us today. So thank you very much for attending September's webinar. I hope you've all got some nuggets to take away to your client meetings this week. And as always, any questions off the back of today's content, feel free to reach out to our support team. And as a reminder, the email is strategicteam@blackfinch.com. We'll make sure we get back to you as soon as possible. But the next webinar will be held on Tuesday, the 1st of October, same time at 8:50. And I'm really looking forward to seeing you there. So bye for now. Thank you very much.